Well, the stock market certainly seems to be pretty happy on its way into the holiday. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we have continued recovery here on Wall Street and in broader markets before everybody goes off for the Thanksgiving holiday, at least in the U.S. So is this now a rally that we can expect to have some follow through, or are we just looking at the markets evening back out after what was obviously a very ugly week last week, heading into this low liquidity period that we're going to get around these closures? And is this more positioning than it is a true risk on sentiment shift? That is to say, are the markets done with the sell-off in earnest, or are we just waiting to get through the holiday to get back to bearish business? That's what we're going to try to figure out here as we look at what happened in these markets today and what may be on the horizon here going forward. Let's take a look at the price action first. This is how we did today. S&P up 0.9%. Nasdaq up 0.5%. Interestingly, Nasdaq, the soggy of the bunch, really it was Russell, which we don't have on the screen here, that did best of all. A very impressive rally for the Russell today. It ends up being net up 2.2 almost percent, but interestingly, it's not like the usual suspects are outperforming here. Yesterday, of course, we had a strong day in markets. Also, this was how we started, and we can see the Nasdaq very much outperforming, up 2.8% yesterday. This is not the story that we see here today. I mean, technology, the main, of course, driver of what's going on in Nasdaq, and because it's so dominant market cap-wise for equities in general, it's up, but only about 0.3%. The really big movers today come elsewhere. Healthcare, consumer discretionary have big days here, up over 2% apiece. Materials have a relatively big day, but the usual powerhouses of what has been the rally since those April lows, and even before then, even before this year, the sort of AI hope and prayer narrative for this to be a transformational thing that ultimately gets us into the kind of multiple expansion and into the kind of build out economically, market-wise, that was the telecoms revolution, or perhaps railroads. All of that, not the narrative here today, apparently. Yields down once again. The idea that we're solidifying on a Fed rate cut in December once again seems to be a driving force in this narrative. And not surprisingly, gold up, dollar down, euro up almost 0.4%. So is the yen. Crude oil down 1.5% because it looks like we're maybe de-escalating some of the geopolitical tensions that were baked into prices over the past several days. Apparently, the U.S. President Donald Trump is due to meet Venezuelan President Nicolas Maduro, so perhaps we can avoid a Grenada-like scenario here, despite the fact that the U.S. has been massing forces near Venezuela. And interestingly also, Bitcoin down yet again. So this notion that maybe we're looking at a sentiment shift somewhat poisoned by the risk on assets, the sort of riskier end of the spectrum here, crypto, that's weak here and pointedly isn't confirming what we're seeing elsewhere. Perhaps the sort of configuration between the S&P and Nasdaq is somewhat related to that outturn here. We'll see how that goes. Now, of course, this follows what was a bloodbath last week. We can see it's red across the board. Stocks down a lot, yields down as bonds rise, not so much for Fed reasons, but on haven grounds. Crude down. Gold managed to hold up okay, but the dollar rallied against its major counterparts. And of course, Bitcoin suffered a decline in excess of 10%. So last week clearly had a cadence and a bias. And as we look at what we see here in the first 2 days of this week, it seems like perhaps what we're looking at could still be a correction before this holiday that we have coming up here that is going to drain liquidity out of markets and make for choppy going until we get into next week. That, of course, is going to be an interesting set of circumstances onto itself. U.S. economic data continues to be scarce for the most part, but we are going to be in the blackout window next week for Fed communication because it'll be the week before that December 10th Fed meeting. And so how the markets ultimately reconcile where they are positioned in that world ought to be very interesting indeed, because ultimately what we still seem to be primarily concerned with is whether the Fed is going to give us this rate cut. And that still seems to be the essence of what's happening sentiment-wise. Now, as it stands, maybe these have just become narratives that are so linked that they are now an almost kind of rate cut on, rate cut off kind of a thing. And maybe sentiment is starting to be reflexive back onto itself. That is to say, if it's a risk on day, rate cut odds shift toward more certainty, as opposed to rate cut odds shift and sentiment improves. Perhaps these things have become so interlinked that speculative forces are now looking at these things in a way that sort of takes this relationship and runs it both forwards and backwards. That would be relatively consistent with the idea that what you have here is corrective, because of course last week it was all about Fed rate cuts being uncertain, and clearly the sea of red that you see on the screen there was the result. But as it stands here, the probability that we're going to get a rate cut at this December 10th meeting has recovered heroically here back to 83% or so, 17% that we're not going to get a move. Obviously, that's a far cry from the 50-50 split where we were last week, give or take, and that gave the market such indigestion around the uncertainty of it all. So whether this shift is as corrective as everything else in markets, we'll have to see, because if the markets are at the same time running a retracement sort of effort on stocks, let's say, then this would be the same thing. Because last week was a week where Fed funds futures were tilting away from a cut and stocks were tilting lower. The natural direction for a retracement, even if it's just evening out exposure before the thin liquidity that's going to follow for the rest of the week amid this U.S. market closure, that sort of recoil, that sort of retracement would be stocks up and rate cut odds higher. So perhaps this reflects newfound conviction in this outcome, perhaps not. And it looks mixed, largely because the data that we have had has been as it were, of one voice, not of one mind. The PPI numbers were certainly helpful. We have here September's numbers. Of course, they are terribly, terribly delayed. We still need October's numbers, never mind what's coming up for November. But we finally get this belated September PPI report, and not much doing here. As we can see, these monthly increases are relatively small, nothing jumping out here. And in fact, we can see through this whole tariffs period, PPI is relatively steady. We look at the year-on-year numbers, and they're still within this familiar range, not really going anywhere. We've seen a little bit of a pullback since July into September, back toward the bottom of the year-to-date range, but that's all we've really seen. So wholesale inflation has, for the most part, flatlined. And that, of course, gives the Fed a little bit more of a sure hand in wanting to pursue rate cuts. At the very least, it doesn't scream that pass-through from these tariffs is going to make for a sticky inflation issue, at least on this reading of the inflation data. We wouldn't interpret this as saying the Fed really should back it up and sit on its hands. Here's the retail sales report, again, terribly delayed. This is September's numbers. And here things looked a little bit soggier than expected. Again, seemingly endorsing the idea that cutting rates might make sense to Fed officials. 0.2% was the month-on-month rise here. That's against 0.4% expected, down from 0.6% in the prior month. It was the weakest reading since we got that decline of 0.8% in May, and the smallest gain, second smallest gain this year. So if we ignore here the January decline, the April decline, and the May decline, and only look at the gainers, this was the second smallest one after February, which was basically a flat result, but for some rounding errors. So looking at all of what's going on here, it seems, at least on a monthly basis, there is a sort of weaker view on the consumer. If we look at the breakdown here, the big culprits seem to be motor vehicles. Now, it's certainly not the biggest move in percentage terms, but motor vehicles make up about 20 to 22% of overall retail sales. So when this thing goes up a third of a percent or down a third of a percent, that's a big swing, just considering how much impact this category has on the overall numbers. The other big one was non-store retailers, which is basically e-commerce. And here we're down 0.7%. That makes up about 10, 11% of the total. So between motor vehicles and non-store retailers, we've got about 30% of all of the retail sales basket. Now, was the decline in sporting goods bigger in percentage terms? I mean, obviously. But sporting goods is not exactly the most influential piece here. And so that 2.5% decline isn't the biggest deal. It is noteworthy, of course, that a lot of the weakness in these numbers seems to be in very kind of consumer sentiment relevant categories. So e-commerce down, sporting goods down, clothing down, electronic appliances down, of course, motor vehicles down, and the retail sales control group that basically ends up at core retail sales and strips out a lot of the more volatile, more seasonally sensitive type of stuff. There we actually get a decline narrowly. And so the numbers look relatively weak. Compare this with the consumer confidence numbers that came out on Friday, where we continue to see weakening sentiment despite cooling inflation expectations for the past 4 months. And it starts to make sense why we could be looking at something relatively soggy here. That, of course, a worrying sign for the overall economy, because 60 odd percent of the economy is household consumption. So if this were to, for some reason, give up the ghost, then we have clearly a problem for the economy. But the market seems content to look at this stuff through the lens of rate cuts. And though this might seem counterintuitive, the market seems to be concluding that if the data is bad and if the signs are pointing to weakness, well, that just makes a rate cut that much more likely. And if the markets, from a sentiment perspective, are going to be hinged on the idea that we need to get rate cuts, and that's what they want first and foremost, well, then perhaps there is something to embrace, again, at least from a sentiment perspective, in these signs of economic weakness. Because if it's rate cuts you want, well, then economic weakness certainly helps you to justify it. Now, importantly, we are by no means looking at uniform signs of economic weakness, and this is where things get a little bit tricky. So if we look at the path forward for retail sales at a less jumpy year-on-year way of calculating, then we can see that the trend really since the beginning of 2024 has been pointing toward rising retail sales. Now, obviously, it's not even, and we can see that over the monthly numbers, we've oscillated up and down here, depending on the month, but the trend still looks relatively encouraging. So it is not as though we have some sort of uniform negativity in the signaling here. We pointedly don't. And so while the markets seem to be taking all of this to mean that the rate cut is all but assured here, certainly with 84, 85% likelihood that we get the move, the markets seem relatively convinced. But the data is not nearly as one-sided as those expectations would have you think. So again, 83% chance of a cut, but is the data really justifying all of that? Here is the view here on the economy from S&P Global. This is the PMI data that came out just at the tail end of last week. And of course, what we find here is that the economy is doing basically as well as the multi-year highs that we saw going back to the end of last year, before any of this tariff drama, before we got all of the sort of back and forth that we see this year. So is the economy doing poorly, and does it in fact need the kind of aggressive rate cuts that the markets seem to want? That still looks very much like an open question. And if the markets are going to be this sensitive to rate cut expectations, then perhaps this is more like a correction. And we are going to get a little bit more antsy about this whole thing, perhaps, when we come back to it at the start of next week and anticipation of the Fed's move on the 10th starts to really get front and center. Because if we look here at what the markets have on the menu, it is still well beyond what Fed officials have owned up to. We can see 70 basis points now on the menu for rate cuts next year. The cumulative run between the rest of this year and next, 79 basis points now. So we can see that things have gotten a little bit more dovish, and it's certainly not because the December rate cut has become more convincing for the most part. It certainly has done that, but the big moves have happened in the outlook for next year, where the markets are very dovish indeed. And if you look at Fed policy expectations themselves, we're nowhere near that. So let's say we get this December cut as the Fed envisioned back in September. This right here is 3 cuts, implying September, October, December. And let's say that occurs as expected. The markets, let's say, are right about that now. And for next year, the Fed has 1 cut. The markets have at least 2 with a high conviction on a third. We're 20 basis points into a third 25 basis point rate cut. That is to say, this would say 75 if all 3 were baked in. So clearly, the markets want a lot of easing, and clearly the data is at best mixed on this score. And so the capacity for sentiment to continue to build here might just end up looking suspect. And when we have these kind of clear relationships between sentiment and policy expectations, and those policy expectations don't appear to be especially firmly founded, if for no other reason than we don't have enough data to really anchor them, then we end up with all kinds of possibility that this rebounds back in the market's face. We can see here since that October 29th meeting where Fed Chair Powell talked down December rate cut possibilities, or at least the inevitability of a December rate cut, we've had this pullback. As we've gotten a little bit more dovish on these expectations, we can see markets have tried to recover. So far, the trend's still down. Lower lows, lower highs, and the possibility that maybe a correction in these first 2 days of this week is about all that we can muster. And the approaching liquidity ebb is perhaps the reason for it. The dollar here, a little bit lower as things get a little bit more dovish, but again, impressively, in an up move that's been running since mid-September when the Fed started to actually cut, suggesting that all of the easing that the markets were already baking in had already taken its toll on the dollar in the first 6 months of the year, and there was no more toll to take. So we ended up with a situation where things were starting to go the other way. And so far, while the dollar is not doing great today, the trend continues in spite of ongoing easing, and that perhaps speaks to the dollar's resilience going forward. With that in mind, positioning-wise here, I am looking still at holding long a little bit of gold. That's working today. Still holding short the major currencies, in this case, the Aussie, the pound, the euro against the dollar. I flipped over my yen position on the spot side, which we don't have on the screen here. So I'm now a little bit long the yen against these positions here, but only a little. I'm still very much net long US dollar here. Still short risk, especially in Bitcoin, where it continues to work. It's down another 2% here, this IBIT ETF. Not loving my exposure being in these put verticals in the Russell, but so far it's not crossed any lines in the sand for me, so I'm still holding that. Same thing for the S&P, still holding those put verticals. The long end of the curve has started to work a little bit, so I'm still sitting in call verticals in TLT to capture that. Same thing with crude oil, still sitting in some put verticals there because we seem to be accelerating lower off another 1.65% today. And silver is kind of idling, but as with gold, it seems like an attempt at bottoming has gotten underway, and we're maybe starting to build a little bit of upside momentum. So I still have those call verticals as well going into the holiday. We'll check back in on this next week because this will be the last macro money for this abridged week, but we're back to Monday through Thursday next week as normal. And of course, we're going to have a full conversation about all of these things shaping up for that Fed meeting on December the 10th. If you're watching this on YouTube, like and subscribe. I am also commenting at Ilya Spivak on former Twitter and on Blue Sky, and writing for the news and insights portion of tastylive.com. Happy trading. Happy Thanksgiving if you're celebrating. Certainly keep an eye out because markets outside of the U.S. are open and cross currents can occur in this thin liquidity. The macro money, we'll see everyone next Monday. Happy trading.